We're seeing these inflation numbers, PPI this morning, for example, running hot. And yes, you can make an argument that CPI yesterday suggested that maybe you're starting to see the worst over with. Who knows? I mean, 5.4% year on year still sounds pretty hefty, just in light of everything we're talking about and seeing with the economy reopening. But what are you suggesting? How are you navigating this with markets near record highs?
It's good to be with you this morning. Thanks for having me. We're certainly watching the economic stats quite closely, as you can imagine, particularly the trends at the consumer level, given this Delta variant. That is something that could put a kink in the armor here with respect to the acceleration of the economic activity. We think the inflation numbers are, to use the word, transitory. We do think things will ease off. Today's number we're digging into, but certainly yesterday's number was cooler than expected. And you had a very strong employment report last Friday. So we think the economic activity is going to continue. We think the Fed will certainly have a challenge with respect to shifting policy, because ultimately, we keep asking ourselves the question, can the Fed normalize policy without meaningfully tightening financial conditions? And I think so, to Steve's point earlier, I think it may be a little bit slower than the market may be expecting, and rates will end up lower than the market's currently expecting, in our view at least.
Yeah, so just to dig into that a little bit more, I mean, you can make the argument that we've seen the wisps of a reflation trade reemerging this week in the markets. Is that where an investor should be putting their money to work right now? Is it sustainable?
We think the economy is going to be above trend line for a continued period of time. So with above trend line economic growth, you do want exposure to the more cyclical sectors of the equity market. So whether it's financials, industrials, materials, et cetera. So that's where we are. We still want exposure to those sectors that'll benefit from accelerating economic growth. At some point, that growth will slow down, and then you'll rotate into more secular growers, but we don't think that time has come yet.
Hey, Steve, there's been a lot of discussion about whether or not infection data is a good concurrent proxy for economic growth. J.P. Morgan out today looking at the contrast between the U.S. and Europe in terms of hospitalization rates. They say it's striking. I just wonder, can we start to use it as a canary to look at where we might see growth or outperformance, at least in developed markets?
I think so. Obviously, that's been the rub the whole time here, Carl, is that investors have to be epidemiologists, and they ought to approach that job with a little bit of humility. The doctors aren't 100% sure what's going on, and I don't think the investors should be either. But yeah, I mean, the next thing on my bucket list here, or on the list of things I need to do, Carl, is to see if we can start to correlate what we've seen in terms of infections with economic activity. For example, I was looking at the J.P. Morgan credit card data, which seems to be doing pretty well so far. It's flattened a little bit in terms of the gains that have been made, but it's early days yet. It just seems like the reality of recognizing the reality of what's going on with the Delta variant has just sort of overcome us. And it looks like officials are just now reacting. And the first thing we're seeing is these debates over vaccine mandates and mask mandates. What we haven't heard a lot yet, but could be coming, Carl, are the new lockdowns. I've heard things like Jazz Fest being canceled, some conferences being canceled. When that starts to happen, that's when we start to wonder and worry about where it would appear in the economic data.